Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I am going to walk you through the process of valuing Seanergy stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Seanergy is the only pure play Cape-size ship owner publicly listed in the US. Cape-size ships are the largest dry cargo ships. The company provides marine dry bulk transportation through a fleet of 12 vessels. Its vessels have an average age of 12 years and can carry approximately 2.1 million tons. Cape-size vessels are so big, only the largest deep water terminals can accommodate them. These vessels can carry the heaviest cargo. They were mainly designed to carry iron ore. Let's get started with the model. This is a micro-cap company, 173 million market cap. They're trading at 162 a share, and they have 107 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company has negative free cash flow in 2017 and 18, positive in 2019. Net income is the profit and loss on the income statement. It's revenue minus expenses. And they have negative net income every year. Revenue is the sales for the company. That peaked in 2018 at 92 million, but has decreased in the next 2 years. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses that are directly related to generating the revenue. Examples are cost of labor and the cost of fuel for its vessels. The difference between those two numbers is their gross profit. And the company does have positive gross profit each year. It's the lowest in the trailing 12 months at 12.5 million. Below that is operating expenses. Examples are marketing expenses, insurance, and depreciation. Then below that is operating income. And they do have positive operating income every year. Below that is their interest payments, and you can see they paid more in interest than their operating income. Then below that is other income and expenses. This is usually impairments or other non-operational gains and losses. And the bottom line of the income statement is their net income. And the company has negative net income every year. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. Most of the company's CapEx are purchases of their Cape-size vessels. Operating cash flow minus CapEx gives you your free cash flow. And the reason the company has negative free cash flow in 2017 and 18 is because they were investing so much into their business. 33 million in CapEx in 2017 and 32 million in 2018. The investment in CapEx is a good thing if it gives you a positive return in the future. The company did issue stock to run its business, 2.6 million in 2017 and 13 million in 2019. When a company issues stock, it increases the shares outstanding, making your shares less valuable. The most important part of any business is their operating cash flow. If you cannot generate positive operating cash flow, you don't have much of a business. And you could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. And to calculate operating cash flow, you start with net income, then we have to add or subtract the non-cash items on the income statement. The company passed through an $11 million depreciation expense. This is a non-cash item that brings down your net income, but we add it back here on the statement of cash flows. They also had 1.3 million in stock-based compensation, 9.5 million of other non-cash items, and 3 million in changes in working capital. Even though the company reported negative net income every year, they actually generated positive operating cash flow. And their operating cash flow is growing each year. Let's look at the capital structure. 86 million of equity, 179 million of debt. They're 33% equity, 67% debt. And their WACC is 7.8%. and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4. That's $179 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $149 million. We divide that by 107 million shares, and we get a calculated stock price of $140. They're trading at $162, so they're trading at a 16% premium. It's a sell according to the model. Simply Wall Street values the company at $129, so they're also saying the stock is overvalued. This is the stock price the last 5 years. The stock was never trading this high above 1,000. It appears this high because they did reverse stock splits. They were probably trading at under $1 at this point. That's why they did a reverse stock split, to bring their stock price above $1 so they don't get delisted. A reverse stock split is generally a signal of a company in distress. This company has a beta of 0.77, so the stock moves a little less than the market. The stock has gone down 68% in the past 52 weeks, much worse than the S&P 500, which went up 17% in the same time frame. The 52-week low was 39 cents, the high was $7, and the stock is trading above its 50-day and 200-day moving average. This is a really liquid stock. Almost 60 million shares were traded on average the last 10 trading days, and only 9% of the shares are held by institutions. Over 11% of the shares on float are shorted. If you invested $10,000 into this company 10 years ago, you would have been at over $40,000 at one point. But if you held on, you'd be down to $17 today. These are the company's top 5 shareholders. None of them are big companies that I'm used to seeing. Let's look at their financial ratios. The average PE in the market's 9, the median is 14. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE. When a company has negative PE, you look to the price to sales ratio. Price to sales is stock price over sales per share. They're at 2.5, so they do have a really good price to sales ratio. Price to book is stock price over book value per share. They're at 2.0. They also have a good price to book ratio. Interest coverage ratio is EBIT over interest expense. They cannot cover their interest expense with their EBIT. ROE is net income over equity, negative net income, negative ROE. Current ratio is current assets over current liabilities. They can cover their current liabilities 1.4 times. The company has $10 million of working capital. Working capital is current assets minus current liabilities. So it looks like they have enough cash in their balance sheet to get through the next year or two without needing to take on more debt or selling more stock. This is a recent article about the company issuing more stock. They're taking advantage of their stock price that's been going up lately. The proceeds from this sale will be $75 million. A company needs cash to run its business, but you don't want a company to always get cash by diluting the current shareholders. You want them generating cash from providing a product or service. The best way to look at ratios is to compare them to similar companies. The only other company I did in this industry was Castor and Maritime. And Ship has a better PE, even though it's negative. They're doing much better in price to sales and price to book. They both have a current ratio above 1, which is good. Ship is doing terrible in ROE. Seanergy has much more debt, and they're a much smaller company at 173 million market cap. So to summarize, I have them trading at a 16% premium. This stock has really struggled over the years, more than almost any other stock out there. So it's definitely a risky play when you invest in a company like this. The stock has been beaten down so much, if it does rebound, you could make a nice return, but you have to remember it's a really risky investment. I ranked their free cash flows 5 out of 10 because they did have a positive in 2019. I ranked their revenue 6 out of 10. They are keeping their revenue pretty steady, but with the investment in CapEx, hopefully they'll be able to grow it in 2021 and beyond. And I ranked their ratios 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.